All this fun stuff we have to go through to get a video. All right, hello everybody. Happy Monday. Bex and Cliff, ERA Brokers and
Sun American Mortgage.
Sun American Mortgage. So one thing I learned this morning is that Bex is always right.
Okay.
Just saying. True. We just discussed that right before we started the video. So Bex is always right. Okay, Bex, give us the update.
Yes. Okay. So conventional, this morning we were open in the market at 6.125 on conventional. Advertised rate, you're probably seeing 5.75 to 5.875. That's with some type of a buy down.
Saw that this weekend on a billboard.
Okay. Yeah. So that's with a buy down, some kind of a cost to it. And then on the FHA side, we're starting at 5.99, so a little bit lower than the conventional, of course. And then advertised rate, you're seeing 5.25 to 5.375, again with a buy down.
Okay. Good. We're going to talk about something else, but we did have a nice discussion this morning about a 50-year loan, 50 mortgage. So we may make that a
video.
Subject.
Yeah, I'll definitely keep you guys apprised. It is very early, but it's definitely in the headlines. So if you guys have questions around that, please reach out to us.
It is true. They are talking about it. That's one thing we did.
But it's not for sure.
It's not for sure.
When.
So don't think that it's some kind of weird conspiracy theory, but they are talking about it. So, yeah. Put some questions in the comments and see if we can
let us know.
Something. It'd be good for us too to do research. So okay, we're going to talk about terms, mortgage terms.
Yes.
Right.
Yeah.
DTI.
Yes.
That's the first one.
That's the first one.
Closing costs and also EMDs. We have two acronyms this morning.
Yes.
DTI sounds like a disease.
Yeah.
EMD. Yep. EMT. Anyways.
Yeah.
Okay. What is D? Letter D.
Yep.
T.
I. Yep. So that stands for debt to income ratio. So debt to income ratio is going to be part of how we qualify you for whatever mortgage products we're looking at with you. So we are comparing all of your monthly debts that would show on credit. So we're not talking cell phones. We're not talking, your streaming services, any subscriptions, none of that. Just car loans, installment loans, student loans.
Student loans, yeah.
Any mortgages you might have, and then credit cards are going to be the big ones that we're looking at. So we take your monthly payments on those items plus your new payment of the mortgage that we're looking at and compare that to your income, your monthly before taxes. So gross monthly income. Those are the two things that are being compared.
Because basically, if I'm not mistaken, a mortgage company wants to know, can you make that monthly payment?
Yep.
So they're going to look at your other monthly payments. One question, let's say you have a medical payment.
Okay.
Does that
That's
go
a good
against
question.
it?
Yeah, that does come up. If you have a medical collection item that's on your credit, most of the time we can ignore those. Okay. 9 times out of 10, we can ignore those. Yeah. So that doesn't play into the numbers that we look at.
But if you have a student loan?
Yes, student loans do count. Even if they're in deferment, we have to, by the guideline standards, we have to calculate a minimum payment for those. It's pretty minimal.
Because that deferment could change.
Correct, at any time.
So that's always important. Yeah, obviously car loans, credit card loans. So they're looking at all that to make sure you can make the monthly payment for this house.
Yep. And they're looking at, depending on what loan program we're looking at, the ratio percentage is different. So conventional, for example, is a little bit tighter. Maximum DTI ratio is 47%. So 47% of your income has to cover all of those debt payments plus the new mortgage payment. On FHA, we have a little bit more room. It's about 54 if we really need to push it. So around that 50 mark is kind of what you want to remember, give or take, depending on what loan program.
That's pretty reasonable.
Yeah.
So that's something you're going to want to do before you go stop shopping for houses.
Yes.
It's very frustrating when you go out there and you're looking at this really nice house and you cannot afford the monthly payment. So make sure you sit down, good loan officer with like Bex, and know what your debt to income is, know what your monthly payment is going to be. So that way when you're looking at houses, you're going to feel comfortable knowing that you can afford this monthly payment, right? Because, maybe the mortgage company is giving you a higher one. Maybe you're not comfortable with that. So always talk to a good loan officer about that. So that's DTI.
Yep.
Debt to income.
Yep, you got it.
All right, let's talk about the next one. You hear a lot of closing costs, right? You hear that, closing costs. What does that include?
Yes, a lot of people get this mixed up with their down payment. These are two different things. So you've got your down payment, and then the closing costs are the costs of doing the loan. So you've got lender fees in there. You've got title fees in there, all of the third-party services that are working on your loan to get you secured into this home. All of those people have to be paid and covered. So that's the closing costs. What also might be in your closing costs is if you are buying your rate down. When we talk about those rates at the beginning and we say there's some type of a buy down, those are additional costs that are factored into your closing costs.
Good. Yeah. So, and also with that, there may be some prepayments, right?
Yes.
So a couple, to get yourself ahead, you're going to have an escrow account started for your insurance and your taxes. So some of those things are going to be factored in. It's not as much as you would think.
Right. But if you're only counting on your down payment, it can be a bit of a surprise, especially if you're a first-time home buyer, you're not aware of the differences. A lot of times right now, we are seeing that sellers are still willing to help cover those closing costs, which they are allowed to do. So that is super helpful if you can negotiate that as part of your deal.
And I always say ask for it. They can always say no.
Yeah.
Right, but always ask for it. So again, down payment, you buy a $500,000 house, your down payment is going to be, if you're 3%, 3 to 5, so let's just say 3%, $15,000. That's totally separate from these closing costs that Bex is talking about.
Yep.
So try not to get confused with that.
And the difference as well is anything you come in with a down payment, that gets instant equity in your home for that amount. It goes directly to the purchase price off of that, versus the closing costs are to pay for the other services to get the loan. So those don't have anything to do with the equity that you are or aren't building.
Good to know. Yeah, so just to ask the seller if they'd be willing, even half the closing costs could save you money, buy some furniture for your new house. So okay, so we have debt to income, DTI, closing costs. Hopefully now you understand that. What about EMD, 3 letters, acronym, EMD.
And that stands for earnest money deposit.
You sometimes will hear that EM, earnest money, but EM or EMD.
Yep, those are interchangeable. So that's something, again, just like your down payment, that goes towards the purchase price. And typically people are asking to
1 to 3% would be good. Right now in this market, 1% is pretty common
to do as your earnest money. So your earnest money deposit, once you make an offer on a home and that offer gets accepted by the seller, then there's an earnest money deposit that typically takes place to basically just say, hey, I am in this. I've got some skin in the game. I'm planning on sticking to our deadlines. And if I don't, then you could potentially lose that earnest money deposit if you break some of the rules of the contract.
Yeah. So again, if we use the $500,000 mark, 1% of that is $5,000. That gets written. You just have to remember that earnest money does get cashed.
Yep.
So if you're writing a check, it will go into the broker account. Even with the title company, it does get cashed. So make sure you have that cash on hand, because if it bounces, you're in default.
Problem. Yeah.
So just make sure you have that money on hand. And it's a good idea to let your loan officer, obviously we work together, but let them know where that money's coming from.
Yes.
That's also important, right?
Yeah,
and why is that important?
There's certain sources. If you have that money sitting in your home under a mattress, we don't know where that money came from. And so there are regulations in place because of things that have happened in history that we need to flag that. So it's good for us to know where the money's coming from. If it's a retirement account, if family is gifting you money, if that money has been sitting somewhere, we need to be able to document where that money is coming from.
Yeah, and as a good real estate agent, you want a good one, he's going to make sure you stay on track. He's going to protect that earnest money for you.
Yeah.
If something comes up and you need to back out of the contract, he's going to make sure that earnest money is going to come back to you quickly, within a couple of days. If you don't have a good real estate agent, he's not going to pay attention. You got to pay attention to those deadlines.
Yeah.
Because that's when you go into default.
Yep.
So earnest money deposit will come back to you. A good real estate agent is going to protect you in that regard.
Yeah.
But just to know what that is. And just remember, it's not in addition to the purchase price. So again, if we use the $500,000 mark, you put $5,000 down in earnest money. At the end, you still owe $495,000.
Yep.
So you just take that minus that $5,000 off, or whatever earnest money, minus it off the purchase price.
Yep.
And then, there's other factors involved in where the money is going to come from. So
yes.
And you can use that part of your down payment.
Yep.
So again, if you're doing $15,000 down payment, at closing, you're going to owe $10,000.
Yep.
Right. I hope I explained all that.
Yep.
Okay. Good. So we got the 3: DTI,
closing costs,
and EMD, earnest money deposit. So debt to income, closing cost. earnest money deposit. And just remember, Bex is always right.
If you have any questions on any of those terms, or if you want us to go into any more detail, please reach out. We're happy to jump on a phone call and go over it in more detail. Yeah,
here's the QR code. I mean, set up a free consultation. Just find out what the terms are. Because most people only buy 1, 2, maybe 3 houses in their lifetime. So, and we do this every day. So we know what the terms are. And sorry, sometimes we do use the acronyms. And just ask. Don't hesitate to say. No, there's no dumb question in real estate, right? Like, what in the world is EM or EMD or DTI? So just ask, and even if you're out of state, you're going to hear those terms. Ask your agent, ask your loan officer. What is that? Be educated so that way you know what you're doing. It's a big purchase. So, great. Thanks, Bex. Hope everybody has a great week. We'll see everybody next week. If you want to know more about that 50-year loan, please write something in the comments.
Yeah, let us know.
Okay, see you. Bye.
Bye.